Welcome back to Smart Stock Sam, where we strip away the noise, follow the smart money, and find the real trade hiding underneath all the headlines. Today, we are doing something I almost never do this early in a week. I am issuing a warning, not a prediction, not a maybe, a full-on, time-stamped, get-your-head-in-the-game warning about NIO Inc. And this warning expires on June 19th. If you are holding NIO right now, if you have been eyeing it as a dip buy, or if you have any meaningful exposure to the Chinese EV sector at all, you need to hear everything I'm about to tell you before that date arrives. Because there is a hidden tripwire built right into the options market that almost nobody in the retail space is talking about, and it has the power to dictate exactly where this stock moves for the entire week ahead. Here is what we are covering in the next few minutes. We will look at the raw price action and what it is actually telling us beneath the surface. We will go into the dark pool short data, the kind of institutional footprint the big players do not want you following. We will decode a specific options market signal that is acting like a gravitational force on the stock price right now. And then we will build a clear, level-by-level trade plan for the week of June 15th through the 19th. By the time this video ends, you will know exactly what to watch, exactly what to do, and exactly when to walk away. Let us get into it. So first, let us set the scene. NIO closed at $5.21 on June 12th. Just 10 days before that, on June 2nd, it had peaked at $6.01. Think about that for a second. Retail traders were getting excited. Momentum looked like it was finally turning. And then, without warning, the stock was systematically walked back down. Not in one dramatic crash, slowly, deliberately. A grinding, high beta contraction that took it from $6.01 all the way back down to $5.21 in a matter of days. And right now, it is sitting at a crossing point, a psychological battleground where the next move matters enormously. Does that sound like normal market behavior to you? Because I promise you, it is not. To understand why, you have to appreciate the tug-of-war this company is stuck inside. And I mean a genuine, brutal, two-sided war. On one side, you have NIO fundamentally executing one of the most impressive operational pivots I have tracked in the EV space in years. On the other side, you have external forces that are actively crushing the valuation ceiling. And when those two forces are roughly equal in strength, the stock does not move up and it does not collapse. It gets compressed. It becomes a coiled spring. And that coiled spring cannot stay compressed forever. Let me start on the bearish side, because if you are going to trade this intelligently, you cannot ignore what is working against NIO right now. There are three enormous storm clouds overhead. The first one is the geopolitical nightmare that dropped out of nowhere. The United States Department of Defense added NIO to its 1260H list, officially designating it as a so-called Chinese military company. Now, NIO is fighting this aggressively and denies any military ties. They are threatening legal action. But here is the uncomfortable truth. The market does not care about fairness. The market cares about risk. That designation alone scares away entire categories of American institutional capital because many funds have compliance rules that restrict them from holding companies on that list. So even if NIO ultimately wins that legal fight, the overhang is real and it is happening right now. Second storm cloud, NIO's own CEO, William Li, warned publicly that domestic auto retail sales in China could fall by 15 to 20% this year. 15 to 20%. That is not a rounding error. That is a structural contraction in their home market. And the third layer on top of that is margin cannibalization. The Chinese EV market is locked in a savage price war. Every major player is slashing prices to steal customers from the others, and that destroys the margins that make a company actually worth owning at any price. Now, if I stopped right there, the story would sound completely hopeless. And a lot of retail traders have stopped right there, which is exactly why this opportunity exists, because internally, the story is almost the opposite. NIO is guiding for 110,000 to 115,000 deliveries in their second quarter. Their flagship ES9 SUV alone is expected to hit 10,000 deliveries this June. But here is the part that is genuinely underappreciated by the market right now. They have made a move on the supply chain that is saving them real money, not theoretical money. NIO transitioned to their own in-house smart driving chip, the Shenji NX9031, replacing expensive NVIDIA hardware. That single decision is saving them 10,000 yuan per vehicle. And because of that, total research and development expenses actually fell by over 40% year over year in the first quarter. That is not a company that is burning cash carelessly. That is a company getting leaner while scaling up. And to fight the price war without cannibalizing their premium margins, they launched the Onvo L60S UV, a mass-market product starting at 192,800 yuan, designed specifically to steal high-volume market share without touching the NIO flagship brand. So why is the stock still sitting at $5.21 if the fundamentals are actually improving? 2 words: short pressure. Let me show you something that most retail traders completely miss. There are currently over 144 million shares of NIO sold short. 144 million. To put that in context, at current trading volumes, it would take over 6 full trading days just for those short sellers to buy back their positions. But it gets more specific than that. When we look at the daily short volume data from early June, off-exchange dark pool short volume ratios were consistently running between 33 and almost 44%. What does that mean in plain English? On some days, nearly half of all NIO trading volume was institutional short selling being deliberately routed away from the public exchanges, hidden from your order book, specifically to conceal the footprint of whoever is driving the stock lower. And here is the thing that makes this almost unfair. The borrow fee rate to short NIO right now is a microscopic 0.36%. It costs these short sellers almost nothing to hold their positions open indefinitely. There is zero financial pain keeping them in the trade, zero urgency to cover. So that is the supply side of the pressure. But what about the demand side? What exactly is keeping the stock from collapsing entirely? This is where it gets fascinating because the answer is sitting right in the options chain. And this is the data I promised you at the top of the video that changes everything. For the June 18th expiration, which falls right at the end of our trading week, there are over 3.3 million total open interest contracts. But zoom in on the $5 strike price. It is an absolute monolith. Over 87,000 call contracts and nearly 59,000 put contracts are clustered right there at the $5 level. In the options world, this creates what traders call a pin. Market makers, the institutions on the other side of all those contracts, are heavily incentivized to keep the underlying stock price as close to $5 as possible by expiration Friday. Why? Because if the stock pins at $5, the maximum number of those contracts expire worthless, which means the market makers keep all the premium. They collected billions of dollars worth of those contracts, and their job on expiration week is to make sure as little of it as possible gets paid out. Think of $5 as a gravitational black hole sitting right underneath the current price of $5.21. Every single day this week, that gravitational pull is going to drag the stock back down toward that level. Now, here is the question that should immediately come to your mind. If there is that much institutional short pressure and a $5 options pin pulling the stock down, why are the world's smartest money managers buying more of it? Because they absolutely are. We currently have 457 institutional owners holding over 280 million shares of NIO. CYVN Investments sits on a dominant 17.9% stake. But the data point that stopped me cold when I looked at the latest filings is this. BlackRock, one of the most sophisticated asset managers on the planet, actively doubled their stake in the first quarter of this year, reaching 10.73 million shares. Funds like D.E. Shaw, Susquehanna, and Morgan Stanley are holding the line, and there has been zero major insider selling at the company level. The people who have the most information and the deepest pockets are using this artificial price suppression to accumulate the stock at a steep discount. Does that tell you something? It should. Wall Street's public consensus backs this up quietly. The institutional average price target on NIO right now is $7.26. The stock is trading at $5.21. That gap, nearly 40% upside, is not the market calling this a screaming long. It is the market saying the current price is a severe dislocation from fair value. HSBC upgraded NIO to a buy with a $6.80 target. Nomura upgraded to a buy with a $6.60 target. Even Bank of America, which sits at neutral, still places a $6.70 target on the stock. So, let us synthesize all of this into what you actually need to watch for the week ahead. 3 metrics. Only 3. First, the $5 options pin. If NIO closes a full trading day below $5, it violates that massive put wall we discussed. When that happens, market makers are forced into delta hedging, meaning they have to short the stock themselves to neutralize their own risk exposure, which accelerates the downside into a spiral. A daily close below $5 is not a dip, it is a trapdoor. Second, margin preservation. NIO printed an 18.8% vehicle margin in Q1. Watch what the early Onvo L60 sales data does to that number. If the cheaper mass-market vehicle dilutes the blended margin without the Shenji chip savings offsetting the difference, the profitability pivot thesis gets complicated fast. Third, the 1260H list developments. Watch the off-exchange short-volume ratios daily. If they climb above 40% and stay there, it signals ongoing institutional forced selling, and the stock will remain decoupled from its improving fundamentals no matter what the quarterly numbers say. Now let us talk about the actual trade. My official bias for the week of June 15th through the 19th is neutral to bullish, specifically a mean reversion bounce play. We are being tactical, playing the channel, and respecting the math. Your ideal entry zone is between $5.22 and $5.25. But do not buy blindly into weakness. You want to see a confirmed daily open above the 20-day simple moving average of $5.21 first. That confirmation tells you the short-term selling exhaustion is real and not just a dead cat bounce. Your hard stop loss, non-negotiable, is $4.95. If the stock breaks below that level, the $5 psychological floor has failed. The options pin breaks, the delta hedging spiral potentially begins, and the entire trade thesis is invalid. You cut it. No questions asked. If the bounce plays out, your first take profit is $5.37, aligning with the 50-day moving average where previous recovery attempts have stalled. Your second take profit is $5.50, where over 60,000 open call contracts create a ceiling of overhead resistance. For the medium-term runners, the $6 price target aligns with the 200-day moving average and historical overhead supply. Now let us be honest about what can blow this trade up entirely. On the downside, 3 scenarios invalidate everything. A clean break below $5 triggering that delta hedging death spiral, a sudden escalation in U.S.-China trade tariffs that threatens supply chains, or early sales data showing the Onvo L60 is failing to capture meaningful market share. If any of those 3 show up on the newswire this week, you close the position and you walk away clean. But here is the upside scenario that keeps me genuinely intrigued. And I want you to ask yourself honestly, what are the odds of this happening before June 19th? What if NIO SQ2 delivery data comes in significantly above 115,000 vehicles? What if they successfully challenge and get removed from the 1260H list ahead of schedule? What if a macro breakthrough in U.S.-China relations drops over a weekend and resets the entire geopolitical risk premium for Chinese equities overnight? The math on any one of those scenarios is almost poetic. Remember that 0.36% borrow fee? That means 144 million short shares are sitting in open positions with almost zero financial pain keeping them there. But if a major positive catalyst hits and hits fast, those short sellers have enormous profits to protect, and they will all try to cover at the same time. What you would get is a violent, face-ripping short squeeze that would make the June 2nd rally look like a warm-up. Now, what are the actual odds of that happening before June 19th? Probably low, but you need to know it is a loaded gun sitting on the table. Before I bring this home, I need to be very clear about something important, and I want every single one of you to hear this. Everything I have shared in this video is strictly for educational and informational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any security. I am not a licensed financial advisor. Every trade carries risk, and you can lose money. Past performance and price targets from analysts do not guarantee future results. Always do your own research, consult with a qualified financial professional, and never invest more than you are prepared to lose. The content here reflects my own independent analysis and should not be treated as personalized financial guidance for your individual situation. So here is the bottom line on NIO. The company is fundamentally executing one of the most impressive operational pivots in the EV sector right now. Leaner cost structure, ramping deliveries, smart multi-brand expansion. But the market is not a scale that weighs facts. It is a voting machine, and right now the votes are being cast by dark pool short sellers, a geopolitical risk premium, and a $5 options gravitational pull that expires on June 18th. The trade is clear. Respect the $5 floor, watch the 3 metrics we outlined, play the mean reversion bounce with a hard stop at $4.95, and do not fall in love with this stock until either the macro environment shifts or the Q2 deliveries come in so far above expectations that those 144 million short shares have no choice but to run. Now I want to hear from you directly. Think carefully about this one. If NIO gets removed from the 1260H list before the end of the year, do you believe the stock can reach the analyst consensus target of $7.26? Or do you think the China macro headwinds are simply too heavy for even that catalyst to matter? Drop your answer in the comments. I read every single one, and I will be responding this week. If this breakdown gave you a clearer picture of what is happening under the hood with NIO, hit the like button right now. It genuinely helps this channel reach more independent traders who need this kind of analysis. And if you are not subscribed yet, hit subscribe and turn on the bell so you never miss a week where I might be about to save you from a bad trade or hand you a great one. Here is something else I want to offer you. This channel now has an exclusive membership community, and if you are serious about leveling up your investing or your trading, not just watching videos, but actually building real skills, getting early access to my setups, and getting priority replies to your queries, want custom analysis on stocks you have, this membership is built for you. The link is in the description below. Come join us and let us grow together. And if this video gave you real value today, if it changed how you are thinking about NIO or gave you a framework you will carry into future trades, consider sending a super thanks right here on YouTube. It is a small gesture that means everything to a channel that independently researches and produces this content every single week without sponsors telling us what to say. Every bit of support goes directly back into making these breakdowns better and more useful for you. Trade smart. Protect your capital, and I will see you in the next one.